All right, we have a lot to cover today, so let's go ahead and get started. Thank you, everybody, for joining today's webinar. We were excited to launch Reunion's Market Monitor, which covers data and insights to help both buyers and sellers navigate tax credit transfers. Before we start, we'll go over a few housekeeping items on the next slide. We are recording this webinar, and we'll publish a video and transcript in about a week. If you have any questions, please feel free to drop them in the chat. They won't show up for the broader group, but the panel will be able to see them. If you have any issues at all on connectivity, please feel free to email sam@reunioninfra.com. So without further ado, we'll go ahead and get started. Today's conversation will focus a lot on the tool itself. We'll give you a detailed walkthrough of the Market Monitor. But before we get there, we'll do some introductions and talk a little bit about current events. Next slide. So I'm sure all of you are aware of Reunion and who we are, but by a brief way of introduction, we are the leading platform for clean energy tax credit transfers. Since the beginning of 2024, we have facilitated over $4 billion worth of tax credit transfers, and that has been critical to powering solar, wind, battery storage, manufacturing, and other types of clean energy infrastructure. We work very closely with both buyers and sellers to make sure that we've vetted both buyers and sellers, and we work very closely with both sides to shepherd them through the transaction process, which includes, getting very involved in negotiations and due diligence. Today, I'm very excited that we are hosting an all-Reunion panel, and very excited to have Connie and Dennis from our team, who I have the pleasure of working with every single day, on the panel. So I'll first hand it over to Connie to give a quick introduction.
Thanks, Andy. Connie Churn here, head of transactions and finance. And in case it's helpful, my background is primarily working with tax credits and renewable energy infrastructure projects. I have over 20 years of experience working with tax credits, including 7 years of public accounting, project finance, structured finance, financial products at SolarCity Tesla, and also spent some time doing investment banking, arranging for tax equity investments. So really excited to share all of our market intel with you all today, and I'll pass it over to Dennis.
Dennis Cook, everyone, Director of Business Development and Research for Reunion. Thank you so much for joining us. We're going to dig into the Market Monitor. I'll just say this has been a labor of love, heavy on the research component, and great to see familiar faces on both the buy side as well as the sell side of the market. Thanks for joining us.
Thanks, Connie and Dennis. And I'm Andy Moon, co-founder and CEO of Reunion. I work very closely, particularly with buyers of clean energy tax credits, but have a long history prior to Reunion of doing clean energy financings, including tax equity and other project finance structures. Let me hand it over to Dennis to give the background on the Market Monitor.
Yeah, thanks, Andy. We thought we'd kick things off today with just a bit of background, sort of where this tool started, how we plan to maintain it, how the data comes in, and then equally important, where we think it's going. And our Market Monitor started as an internal tool, really a data set that we maintain internally to answer the question, what is market? Virtually every conversation that we have, buy side, sell side, peers in the market, professional advisors, we get some variation of, what are you all seeing in the market? Where is this pricing? How are terms playing out? And we really wanted to bring those answers to life. We decided to flip the switch from an internal tool to an external tool when that volume of data kind of approached the 200 transactions mark, and we started getting to the high billions of deal volume. We source data from three locations. One, of course, our own platform, our own activity in the market. Second, trusted advisors, partners that we know can provide verified, concrete data. And then, of course, SEC disclosures. I'll say when we add new transactions, when we add new data, we have a pretty robust verification process, upwards of 12 discrete data points to ensure that we are getting accurate, non-duplicative data. Looking ahead, we plan to update the data on a quarterly basis We hope that time frame collapses. In a perfect world, this would be real-time data in the not too distant future. We're also planning to add more data as well as data views. Something we'll talk about towards the end of the webinar is how you all can help us expand our data presence. I'm thinking of ways to contribute as well as suggestions for future data. I'll pause there. Andy, back to you.
Great. And this slide has a link to the market monitor itself that you can access on our website. Very simple, and you can even follow along as we're talking through the data. Before we flip to the market monitor, we do want to touch on briefly on the next slide. As everybody here very well knows, we are in the middle of a legislative session, and on Friday we published our latest assessment of the Senate's draft bill, including a credit-by-credit look at changes to the phase-down schedules, transferability, and FEOC. I've copied the table here, but since everybody's asking us a question, we will spend a few minutes giving a very brief update here. The Senate Finance Committee at the beginning of this week released their draft of the OBBB. There's lots of negotiations still ahead of us. It does need to go to the floor of the Senate for a vote, and once that's complete, it will go back to the House. I'll touch on a few major highlights. One is that deal activity has picked up quite a bit since the original House draft came out. And the reason for that was there has been a fear that there might be a retroactive clawback of 2025 credits. And that definitively is not the case. That has not been contemplated in any of the drafts. And so that has given buyers, especially, a lot of confidence that 2025 credits will be respected. And so we have seen a lot of pickup in the activity. As you'll see from the data, the buyer activity in Q1 on 2025 credits was soft, but it has materially picked up since then. There are two buckets of changes that are worth discussing on this chart. The Senate draft preserves transferability for the same schedule as the credits are available, which is welcome news for the transfer market. But that said, there is an early phase down of wind and solar credits based on the beginning of construction. And so what that means is that projects that begin construction in 2025 will have the full credit amount, but starting in 2026, that credit amount falls to 60%. In 2027, it's 20%, and then there's no credit available for wind and solar starting in 2028. That is not true for other technologies that enjoy the tech-neutral 45Y and 48E credits. So storage, nuclear, hydropower, geothermal all retain their original credit schedules. Wind and solar were also the focus of sort of another provision, which is that wind and solar lease property that would qualify for the residential credit will no longer be available after 2025. And on the 45X front, wind components specifically are not eligible for 45X credits after 2027. As you'll see in this chart, other components and critical minerals for 45X are still available after 2027, according to the original or extended schedule. The other major change that's worth discussing is FEOC, or Foreign Entity of Concern. The intent there is to ensure that credits do not benefit China, North Korea, Iran, or Russia. This will add a lot of complexity in terms of compliance. The good news is that FEOC does not apply to projects that begin construction in 2025. So we will have a very strong pipeline of projects that will not be subject to these restrictions that begin construction in the near term. So lots of negotiation still to come. We will keep you all very up to date on any changes through posts to our website. If you have any questions at all about anything, I will just remind everybody, please feel free to drop questions in the Q&A box at the bottom. And with that, we will move attention to the centerpiece of today's presentation, which is the market monitor itself. So I will hand it over to Dennis.
Thanks, Andy. We have clustered the tool into different pricing series, and we'll different data series, excuse me, and we'll start with pricing. What we want to talk about first is our median by credit type pricing series, something internally we call the vintage chart. What this chart shows is gross pricing to buyers, what the buyer expects to pay by vintage. So we have data for 2024 as well as 2025 credits. This only covers spot pricing, meaning transactions in a given year, so not a multi-year or single year forward. One thing to note it on the x-axis, the quarter is relevant to the given vintage. So current Q1, that would be Q1 for 2024 vintage or Q1 for the 2025 vintage. We developed these charts to bring to life two things. One, the seasonality in the market. This is something we've talked about extensively over the past couple of years, where we generally see elevated pricing toward the latter half of the year. The second thing we want to highlight is how pricing trends from one year to the next. Are there macroeconomic considerations or market level considerations that drive pricing? And as we'll discuss later by credit, we have begun to see some intra-year differences. In terms of how to use these charts, it's really a function of what should I expect to pay and when, or what should I expect to receive and when, depending on when someone buys or sells a tax credit. What we've told a lot of the buyers in the market is the earlier you move in the year, likely the better pricing you will receive. We'll take a quick look at the Section 48 ITC chart. Two trends I want to talk about. Touched on it before. With 2024, we did see pricing trend up towards the latter half of the year. And I should say, these are for transactions of $25 million notional value and above. We will release a $5 to $25 million pricing series in the not too distant future, but you can assume the trends are similar. We expect that latter half of the year elevated pricing to likely persist into 2025. Particularly, as Andy mentioned, we've seen the Senate bill likely unlock a lot of buy-side activity. The other trend, softening pricing for 2025. Given a sort of wait-and-see posture, and this is sort of across various credits, we have seen some softening in price for 2025 vintage credits. That's more pronounced on the lower end of the market, the $5 to $25 million range, but we have seen that a bit on the higher end of the range.
Thanks, Dennis. I'll just add there that we found it very important. We initially had lumped 2024 and 2025 vintage together for Q1 2025, but we realized there was a material difference between a very dwindling supply, rare supply of 2024 credits that were trying to get sold in early 2025 that were trading at this 94.5-cent price range versus 2025 credits trading in Q1 that were trading at a lower level that you'll see with this blue line.
Let's quickly comment on 45X, the Advanced Manufacturing Production Credit. This is, as I think a lot of folks have heard by now, a widely adopted credit. It was new with the Inflation Reduction Act, and since it hit the market largely by virtue of the size of potential deals, we've seen significant buyer interest. Two trends. One, there was a bit of a price discovery exercise late in 2023, early into 2024. And since we've traveled through that, pricing has generally come up and directionally paralleled that of Section 45 production tax credits, 45 PTCs. And we expect that trend to persist into 2025 and then following vintages. The other thing to notice, similar to the 48 credit, we have seen a touch of softening in pricing for 2025, but we also expect that to correct into the latter half of the year. One thing to note on this chart, we do not have data for the 2024 vintage for the following Q2. When we do not have sufficient data to necessarily provide a data point, we do not publish it. And this is largely a function of there's frankly not all that many large 45X deals being transacted in Q2 of the following vintage year. So this holds true for all of our charts. If we do not have a sufficient data, we do not publish something. We note that at the bottom.
Dennis, are you finding that the production credits, 45X and 45, are being contracted earlier in the year versus ITCs?
Very much so. Great question, Andy. What we typically see is 45X and 45 payable quarterly in arrears. We generally see buyers move towards those earlier in the year. And of course, sellers prefer to sell them earlier in the year as well. All right, moving on. Let's talk about pricing by credit type by spread. A median price, of course, is not the full story. There are a number of deal pricing factors, idiosyncrasies that result in a spread. And so what we've done here is shown sort of a P25, P75 of pricing by credit type. Not surprising, we see a bit more dispersion among 48 ITCs, which is largely a function of counterparty as well as a variation of technology and payment terms within ITCs. When we think about how to use these charts, what does a buyer, seller, and their advisors do? Call it another spot check on pricing, albeit where one can say there might be some nuances with my transaction where it's priced above or below the median, and that's reasonably so. 45 PTCs, again, lower dispersion than the ITCs, as well as pretty tight conversion around the median through time. We did see a fair amount of dispersion in Q1 of 2024, but we largely view that as a bit of a price discovery exercise. With 45X, I mentioned earlier, pricing elevated since the credit became available, and we've seen it trade in increasingly tight bands. Again, paid quarterly in arrears, a production credit not subject to recapture. We expect this trend to continue of elevated pricing as well as fairly tight dispersion. Let's go on to technologies. For the sake of clarity, we have pulled out we've isolated pricing for two specific technologies, residential solar or resi solar, as well as biogas RNG. And so the ITC prices that we shared earlier, those are exclusive of resi as well as biogas. And we elected to pull these out, one, because it's a fairly liquid market, but second, because they do tend to price differently. Candidly, a lot of buyers may prefer what we would consider, mainstream technologies of solar, wind, battery storage. And so we thought it best from a efficacy perspective to specifically pull these out. A couple of observations on these chart. Resi has traded fairly consistently. We do see some variation by deal size, but it tends to trade around 92-cent median throughout the year. Biogas is a pretty interesting story. Earlier in 2024, last year, we had a lot of buyers who said, we really wanted to take a look at solar battery storage ITCs. We're not all that interested in biogas. As the year progressed, as those traditional clean energy technologies became, frankly, less available in those markets, as those credits became far more uncommon, we found buyers saying, you know what, okay, I'm willing to look at biogas. And so we saw a similar trend of pricing significantly increase in the latter half of 2024. And it has since come back down towards that, call it 90, 91, 92-cent range. I expect a similar trend again into 2025. Looking ahead, we will likely make additional technology-specific charts. And with that, I'm going to turn it over to my colleague, Sam, to run a quick poll. What other technology price series would you like to see? Please let us know. This is your tool. We want to hear from you.
Dennis, while we wait for people to fill out the poll, talk to us, since you spend a lot of time with Fortune 500 buyers. Talk to us about sort of the buyer pool. What's the supply and demand dynamic on resi solar? How many buyers, what percentage of buyers are willing to entertain resi solar portfolios?
It is a smaller segment of the market, but one that we have seen grow with call it an education process. My colleague Alessio De Francis published a really thoughtful piece. Alessio De Falsis, excuse me, published a really thoughtful piece on why we like resi, some of the unique risk profiles. And as buyers have become aware of the credit, aware of some of those, call it frankly, risk exemptions, PWA, for instance, resi is generally exempt from PWA. We have seen more and more larger established buyers gravitate towards resi. And just this week, following the Senate bill, we've seen a lot of just very recent uptick in activity.
I think it's worth mentioning that for each transaction or transaction class, there is a supply demand dynamic, and the pricing it comes out of that. How many people are willing to entertain resi, or how many people are willing to entertain a forward purchase of 2026 credits? It really just depends on how many buyers are willing to come to the table for that and how bad they want it. That's why we see pricing go up at the end of the year when there's a small supply of 2024 credits and buyers that have decided they want to buy, they've gotten approvals from their board, and they just need to find a credit. Pricing goes up. So yeah, this is a market, and there is supply and demand for everything. And we've certainly seen that as buyers have entered the market, for whatever reason, there is a bias towards a smaller number of discrete projects versus portfolios, whether that's resi or CNI or just a large number of portfolios. But I think what we're seeing as the market is maturing is, as buyers get more comfortable, as buyers want to see a little bit of a bigger discount, there is increasing comfort with portfolios versus individual assets.
Eddie, should we quick comment on the investment grade indemnity?
Sure
And
thing.
then we'll dig into the poll results.
Sounds great.
So a chart that is an extension of something we published in our 2024 year-end buyer survey. Andy mentioned Fortune 500 buyers. We are seeing more and more buyers, irrespective of size, have a preference for an investment grade counterparty. And as a consequence, we have seen a market premium for credits from an investment grade sponsor. Depending on the buyer, it could be upwards of 1 to 2 cents relative to, say, a comparable project with tax credit insurance. Of course, not all sellers are investment grade. There is a finite volume of supply, and I would say I would generally describe credits from investment grade sellers as price to perfection, meaning price at the significantly higher end of the range, with frankly not a lot of room for negotiation. 96 and a half cents for PTCs, 95 cents for ITCs as general numbers.
And this was true for 2024. I think, because the market is softened for 2025, we are seeing some lower pricing, but still, nonetheless, to Dennis's point, it is a 1 to 2 cent premium in general versus a similar credit that, might require tax credit insurance. Any poll results that we should share with the group, Dennis?
Well, I might have to turn to Sam on that. Sam, do you have the poll results?
I do. It's a tie for commercial and industrial CNI solar and community solar, 24% each.
I must say I'm surprised by that. That is great feedback. Thank you all. And we won't disclose how that's split among buyers and sellers, but we'll just assume that those are 2 charts to come soon.
I had assumed that the 100 million plus would have been the highest demand, so that is a surprise to me as well.
It looks like large utility wind is not the way of the future, at least for this, as the poll is concerned. And with that, Connie, why don't you walk us through key commercial terms?
Yeah, sounds good. So I think we've been talking a lot about pricing and technology, and there are other commercial terms, buyer fee reimbursements, for example, that could impact net pricing, so your take home, as well as just other also very important things like execution risk. So buyer fee reimbursement, we'll just start with that one. As pricing and payment terms have become increasingly standardized, these terms are starting to get a lot more attention because, as I mentioned before, they impact, really the net take home to the extent sellers are covering quite a bit of buyer fee reimbursements. These reimbursement amounts can include any sort of reasonable transaction expense, typically legal or other advisory expenses that may be incurred in connection with diligence or definitive documentation. The charts that you see here, these are based exclusively on reunion-supported transactions, so they are not necessarily indicative of the broader market. And we have also not yet included standard deviation. We will look to do that soon. There is a lot of dispersion in this data, typically kind of broken out between larger transactions and smaller transactions. But there are, for example, fee reimbursements typically negotiated in dollars. What we've done here is just convert to percentage, so it's a little bit easier to understand how that might track relative to the overall economics or credit price for a transaction. The relative complexity of a deal can also meaningfully influence the cap, which is another reason you would see a bigger dispersion. That said, for deal duration, this is exclusivity versus deal duration. I think the point of this chart, what we were trying to get at is just, is the exclusivity period in a term sheet reasonable based on, what we're seeing in terms of our deal durations. The duration count starts from when a term sheet is executed and it goes through the signing of a tax credit transfer agreement. That time frame would also include any diligence that's performed up to the signing date. In some cases, there's additional diligence performed after the signing date if there's additional funding milestones, but there's typically a big chunk of diligence that's performed up front. What else can I say about this? I think we've seen these exclusivity periods typically cluster around 30, 45, or 60 days. The actual duration has trended downward, as in fewer deals need extensions to this exclusivity period. Almost a quarter of our transactions have closed under the negotiated exclusivity period that was stated in the term sheet. I think this is in part because I think we work very hard to remove friction from the deal process and get everyone tracking through as quickly as possible. And that's also actually helped to keep reimbursement costs down as well. We do have a number of deals that come in below the cap, which is exciting to see.
Not something that you commonly hear about, but very exciting whenever that happens. An exciting bonus for the seller when they don't have to pay the full negotiated cap amount.
Definitely. And that said, we do have a poll, another poll, and I'll turn it over to Sam. But just what has been your average actual deal duration? We'd like to get some information on deal duration outside of just our own anecdotal data. We've been told that our deal durations are on the short end of the spectrum. So we'd like to hear from you what you've been experiencing.
And to clarify, this is from signed term sheet to closing the transaction.
That's right.
Please be honest.
And if you're closing in less than 15 days, gold star. We actually don't have that as a category. I think we've only done it a handful of times. It's, I would say, on the rarer side of things.
Connie, if I may put you on the spot, what when we have transactions that close under the negotiated exclusivity period, are there any leading indicators? What gives us the warm and fuzzy that we're trending in the right direction in terms of closing on time?
It's typically, whether or not there's enough information to diligence up front. Is the data room in good shape? And we do work with sellers to make sure that as much as possible, that is not a gating item. The other kind of trends that we'll see early on in a transaction is just whether or not the resources are there, lined up, ready to kick off. Are the definitive documentation, whether it's transfer agreement or in some cases also a guarantee agreement or tax credit insurance, are those drafts getting turned, in a reasonable time frame? I would say there are times where you have competing priorities, whether on the buy side or the sell side, and that can stretch out a deal, and you can sometimes lose a little bit of, I guess, momentum, just trying to accommodate for those other priorities within an organization. And those are, usually things that are discussed, pretty candidly up front. There's a high degree of transparency, and we do our best to just kind of stay on top of any sort of communication and, make sure the deals stay on everyone's radar and that we close in a reasonable time frame. I think, closing quickly also helps to manage costs. So to the extent that legal counsel doesn't have to pick something up, relearn it from the beginning because it's been, several weeks since everyone's kind of focused on it, that can drive up deal costs if it continues to stretch out.
We've also found that picking the right counsel, picking experienced counsel that knows what they're getting into and sort of the right level of detail to dive into has a big influence on how fast these transactions close.
Yeah, there are definitely a number of law firms out there that I love working with. I feel like they really truly understand risk. They're very commercial about how they're going to approach, you know, a $1 billion transaction versus a $5 million transaction. The two are, you know, generally not going to be the same in terms of what documentation may be available and how you would approach, in general, just papering the transaction. It doesn't necessarily mean that the risk is different. It's just, you know, the deal itself is different. There's going to be, you know, project specific complexities for a $1 billion transaction that you might not see on a $5 million one.
I'll bring up one point on buyer fee reimbursement before we flip to the poll. I think that over time, in the early market, you know, there wasn't always a fee reimbursement for the buyers. However, most buyers are very sensitive to above the line expenses. And so I'd say as a market in general, on the majority of our deals, we do see as part of the term negotiation, the seller will provide a capped reimbursement to the buyer for legal and diligence fees. However, there are some deals still where there is no reimbursement. That is not, you know, it's the minority, but it does still happen. And I think that just goes back to supply and demand. You know, there are situations where the buyer really has to hit a price target. You know, they really need to hit 93 cents on the dollar. And as a result, you know, the fee reimbursement is just another piece of the economics, and they're willing to say, hey, it's fine. We'll take care of those expenses. So just want to point out that we do still see some deals where there is not a fee reimbursement.
That's right. Or that the cap is lower than the expected cost to the buyer.
That's right.
If you look at the poll results, I'm curious.
15% still waiting on a signature. Well, you know where to reach us.
I wish someone had clicked 15 to 30 days just to, you know, not make it feel so lonely.
You know, I think that 15 to 30 day bucket is challenging and usually requires there be some sort of outside impetus to hit it. Maybe you need to, you know, close the transaction by an estimated payment date on the buy side or on the seller side. If you're a public company, maybe you're trying to close the deal, you know, before quarterly earnings or something like that. That's typically when we see more pressure for a shorter deal duration and when we see parties really hustle. Also repeat transactions, so PTCs that are trading on the spot, if they, you know, want to re-up for the next year, those go very quickly. So that I would say are the maybe the two big kind of transaction buckets that I see in that shortest time frame.
Awesome. Great. So I will go over the next couple of charts here. So we are showing here two charts on supply and demand. The supply chart is coming from Reunion Marketplace data. So over the course of the year, we are continually adding projects to our digital marketplace, and we were able to pull the data from the marketplace to show when our credits hitting the market. So the chart on the left on supply, the percentages will add up to 100%. These are the share of 2024 vintage credits that hit the market. So you'll notice some credits hit the market in late 2023. The majority hit the market in the 2024 calendar year itself. And we had about 7.8% that actually hit the market in 2025. So early this year, we did have projects popping up that we hadn't heard of before where the seller said, hey, I'm ready to sell. But you'll notice that that's a minority of the projects. The demand chart on the right-hand side shows the percentage of term sheets by dollar volume that are executed each quarter for the 2024 year. So these bars will add up to 100%. And as you might expect, the volume of transactions ramps up, and you'll see Q3 and Q4 account for, you know, over 60%, over, let's see, 63% of term sheets were closed in Q3 and Q4. However, what's very interesting as well is that we do see that almost 20% of deal volume for 2024 actually closed in early 2025. Many times these are fiscal buyers that fiscal year filers that are tax credit buyers that need to use the prior year calendar year credits to fulfill their current fiscal year. And so we get calls, a lot of calls from fiscal year filers that say, hey, do you have any credits from 2024 that are still available? In fact, we have right now over $300 million worth of demand for 2024 credits, which are very, very hard to find at this point. One way you can interpret the supply and demand charts from the buyer perspective is it's good to get moving sooner rather than later, because if you wait late in the year, there's a lot of competition. And once the supply starts dwindling, that forces prices to go up. And we did see in Q4 last year, there would be sellers with desirable credits, say it's an investment grade seller selling an ITC, where they would get 10, 11, 12 bids for a single opportunity. Those are very hard opportunities to win. For sellers, there could be an interpretation that waiting a little bit can be to your benefit because pricing has gone up. But that said, when you have a good deal in hand with a good counterparty, we do encourage people to try to move quickly, because the market, it takes time to work your way through negotiating a term sheet and then closing the deal. So we also would not advocate waiting too long as a seller to get your deals done.
One highlight Andy mentioned, that is 2024 data, and 2025 thus far has been a strikingly similar story. So we do expect this trend to persist, and if anything, expect more activity late year into early next year activity among fiscal year filers on the buy side. And I'll reiterate what Andy said because it is very real. We have a substantial backlog of demand from buyers with fiscal year ends still for 2024 credits.
Great. Flipping to the next chart, we have a chart showing the share of seller technology that has appeared on our platform. As no surprise, solar, wind, battery storage, 45X tends to be the majority of what we see on the platform, but we do have a variety of technologies. The next chart on deal size is quite interesting. Now, this is based on deal count. We have split up the size of each transaction, and you'll see a clustering around the $20 to $50 million size range. But that said, we have, we do have quite a number of deals that are $300, $400, $500 million and above. I think Reunion as a firm has done 3 separate deals that have been north of $750 to $800 million. So there are very, very large transactions that are happening also in a discrete fashion. And the final chart for this section is one that is very popular, which is transaction count by buyer industry. I think this goes to show that in 2024, there has been broad participation in the tax credit transfer market. I think that was always the goal here, to expand the pool of capital sources from beyond a few major banks to many, many different types of corporates, and we certainly have seen that. For 2025, this makeup will be different, partially due to the OBBBB, and that's because bonus depreciation, R&D expensing, that does impact different companies in different ways. And so, for example, we have noticed that some oil and gas companies, some pharmaceutical companies, other companies that have large asset investments or R&D have said that their tax liability is much lower than they anticipated, and therefore they will not be a major player in the market for 2025. Now, some of those are one-time expenses, and so they may be back in 26, but the makeup in 2025 of buyers will likely be different than what we saw in 2024.
Bonnie, another question for the transactions team. When we think about these buyer industries, is there one buyer industry than your experience is a quote better counterparty in terms of ability to close, ability to move quickly, or is it a bit of a crapshoot?
I would say it depends more on the organization and
Okay.
their counsel than what industry they happen to operate within. A lot of times doing transactional work is just not a big part of a tax or treasury team that we're working with. Well, it depends. If it's a tax team, it's often not really their standard, day-to-day to drive a transaction. So for them, there's a bit of a learning curve in terms of how to pace, work with legal counsel, that type of thing. So I would say more than industry, yeah, it's definitely based on internal composition and who they use as outside counsel to guide them through the process. I would say the most impactful is probably repeats. So someone who's going through a second, third, fourth, fifth transaction will move much more quickly.
Andy, if you don't mind, I'm gonna hit you with a quick participant question. Does the pricing for transfers backed by investment grade indemnities decrease for multi-year sale agreements?
Is the question, is there less supply of multi-year investment grade opportunities available?
I would interpret it as if you sign up for, if you are a buyer and you pursue a 2, 3, 4 year, let's say PTC strip from a investment grade party, should you expect lower pricing versus if you just made comparable spot transactions?
Oh, that's a great question. We do see, in general, a bit of a discount, and we actually have data on this that it's good question. We should add this to the market monitor, because we did collect this data. In general, the longer the duration of the PTC transaction, there is a discount. Now, that said, we have noticed that there are a number of sellers that know they have a good product. PTCs are sometimes hard to find, especially in volume, especially if you're investment grade. And some of those sellers want to make sure that they maximize their proceeds. So for them, they'll do a multi-year, but they will only accept a very, very minor discount for a multi-year transaction.
I would say also to add to that, for ITCs that do multi-year, for example, because there's a pipeline of projects, I definitely see maybe a larger discount the further out you go, in part just because, placed in service and certainty, especially if anything is scheduled for Q4 in a given year.
I'll quickly address one more question from the audience. Is the transactions count data based just on reunions transactions? The data in the market monitor, I'll answer broadly, except for the commercial terms, is based on reunion data as well as partner data. So the chart that Andy described, which shows sort of that buckets transaction by deal size, that is based on $25 billion worth of transactions from reunion as well as select trusted partners. Great question.
Thanks, Dennis. We have a few more charts to go through, so why don't we make sure we finish those, and then we can flip to audience questions. So Dennis, over to you for credit values.
Sounds great. I'll try to speed through these, and I'll actually jump straight to the energy community adder. So Section 48 ITC, Section 45 PTCs are eligible for certain bonus credit adders. For ITCs, energy community, domestic content, as well as LMI. For 45 PTCs, energy community and domestic content. Energy community, we have seen adoption tick up fast. We are seeing developers specifically plan for the energy community adder when making future investments. For ITCs, significant adoption. PTCs, similar trend line, albeit slightly lower. One thing I wanted my colleague Connie to touch on is actually the sort of energy communities that we see among our sellers.
Yeah, so there are 3 different categories for energy communities. There's statistical area, so non-MSA, MSA areas. Those are updated annually. So if you're pursuing that type of energy community adder, we do see projects grandfathering where possible using beginning of construction. Otherwise, there's a bit of a gamble as to whether or not the statistical area will still qualify at the time a project may place in service. The second category is coal closure. Those don't change. So if you're in one of those, if your project's in one of those, you're generally set, good to go. And then the last category is brownfields. Brownfields tend to be a bit more heavily scrutinized with regard to transactions. I think it's a bit more subjective as things go. It's not just, are you in this published area or not? There is a safe harbor. The safe harbor typically would require additional third-party reports or opinions if you're looking at a phase 1 or phase 2 environmental assessment. So we do see some brownfields, but I would say the bulk of what we see are more on the statistical area category, as well as some of the coal closure categories, which are, I think, in terms of map coverage, a little bit more rare. And then kind of just one final note on energy communities. The energy community adder tends to be more commonplace for ITCs, especially for solar or battery ITCs. It's determined as a percentage of the overall project footprint, which is really nice. So if you're over 50% in that area, then your project will qualify. For wind projects where a facility is generally determined on a per turbine basis, if you're going for the 45 PTCs, then you may be, subject to only certain turbines qualifying and not the, full wind project as a whole. So that's just another consideration.
And I should have said these percentages are based on dollar volume, not count of projects, dollar volume.
That's right.
Tony, you want to touch on domestic content?
Sure.
The talk of the town?
So domestic content, we've seen, a pretty sharp increase in the number of projects that are seeking domestic content adders. In part, that's just because it's gotten a little bit easier with the new elective safe harbors to demonstrate that you are meeting the domestic content criteria to receive an additional 10% adder. We definitely see this more on ITC, solar and battery storage transactions than we do on the PTCs, in part because I think PTCs have a much longer lead time for development in general. When projects have a longer lead time in general for development. So they are starting to tick upward. We expect this trend will continue, especially given, some of the FIAC and other domestic manufacturing considerations that we see in the near to middle term. That said, I think we were planning to do a poll here as well. Just curious how everyone is approaching domestic content. So it'd be great if you could participate. If you're already claiming domestic content, would love to know that. If you're planning to claim domestic content, would also love to know that. And if you're having difficulty sourcing domestic content, please share. And if you're finding the elective safe harbor still very complicated, let us know. This is definitely an area where we, at least on the transactions front, have seen a lot less deal friction. Just, being able to use a table with a specified percentage rather than a very complicated legal opinion that has to look through so many different layers of manufacturing. I think it's made a lot of transactions move more quickly. I would say domestic content is no longer the thing that, takes the longest lead time in terms of diligence. That award goes to PWA now, which we'll cover shortly.
And if your buyers, sit tight and see what this poll reveals. Should we see what people said?
Interesting dispersion. Thank you all for sharing. These are encouraging answers.
Yeah, I'm thinking we need to do a blog on how we see the elective safe harbor used in some of our transactions in case it's helpful for those who are planning to incorporate it.
All right, I will quickly comment on the last chart, average credit percent inclusive of all adders. I'll say this was surprising and self-explanatory, but I'll simply say that ITCs with an average value approaching 40%. From the buyer perspective, I would think of this as ITCs at this point are effectively assuming most ITCs are effectively assuming at least one adder. PTCs trending up, but not to the same extent. And so as you think about going into the market for net new credits, again, ITC, I think most buyers should expect at least one additional due diligence item relative to what they may have experienced, say, in 2024 or 2023. And I'll let Connie take over from here to discuss PWA.
Great. So maybe just quickly what we're looking at. These charts here, they show the percentage of tax credit opportunities measured by dollar volume that are specifically subject to prevailing wage and PWA requirements, or PWA for short. Projects that are under 1 megawatt AC or that begun construction prior to January 29, 2023 are not subject to PWA compliance. So what you see here are, projects that are over 1 megawatt AC and beginning construction January 29, 2023 or later. The pipeline of beginning of construction projects that are grandfathered as exempt is dwindling. So we're seeing a lot more projects that must be PWA compliant. This is a sizable and very growing area of focus, I would say, for tax credit due diligence, because failure to comply with PWA could result in an 80% decrease in the amount of tax credits generated. So there is quite a bit of attention on this, quite a bit of scrutiny. We're seeing a lot of pressure for third-party reports and not just, something that's rubber stamped, but something that's, quite thorough. That said, how to use these charts. So what you probably don't see here in this mix is going to be rooftop solar, as I mentioned before, just due to project size. But for PTCs, over 70% of projects remain exempt. This is in part just because of, as I mentioned before, the longer lead time to get PTC, namely wind projects online. There are a number of tax credits still available for projects that are grandfathered also because it is a 10-year tax credit. And many of those opportunities are going to be spoken for, I would say, if you're a buyer, before they even hit the market. There's a lot of, I think, repeat transactions once you've gotten through the brain damage of diligence and definitive documentation. So as soon as another opportunity is ready to go to market, a lot of times there's a re-up, so it goes quickly. The complexities inherent in PWA compliance and reporting, I think, we're starting to see things like escrow accounts for many transactions to the extent there are cure payments owed, or we expect there might be cure payments owed. That's increasingly negotiated. If there's specific data that you'd like to see around, whether it's escrow accounts or average cure payment, please let us know. But just to start, the charts that you see here are just what we are seeing in terms of just projects that are even subject to these PWA requirements. We're also seeing carve-outs for things like tax credit insurance. So sometimes there's an exclusion where the tax credit insurance may not cover future non-compliance, or future loss of credits due to non-compliance. That's a pretty heavily negotiated item in a lot of tax credit insurance policies. So in case it's helpful to have some additional context for non-qualitative things, that is what we're seeing. We are also seeing just this diligence start to hold up deals. So I would say there's been a number of transactions this year where the only outstanding item to close on fund is PWA. And that can delay for a significant amount of time. And that's expensive, I think, for a lot of sellers who are, otherwise ready to transact, and buyers who are also ready to transact, and they're waiting on a clean report.
And as people on this call may or may not know, Reunion does have a PWA software product designed to streamline and make the process of complying with PWA very, very easy. So if that's of interest, you can reach out to us.
I would be happy to help you with that. Me and my colleague Alex, you may have seen us on other webinars discussing PWA compliance.
Great.
All right, we've got one more poll we want to quickly share. This is a bit of a free form. We'd love to know what data you all would like to see. What information can we provide to make your transactions more efficient, more smooth, to provide further liquidity into the market? I'll say things on our radar as you're typing your responses, things on our near-term radar. Community and C&I solar, two things we touched on earlier. Pricing charts for deals north of 100 million. That's a bit of an asset class in and of itself. Fairly specific deal terms, the percent limitation of liability for tax credit insurance. PWA escrow accounts as a percentage of deal size, and market capitalization among tax credit buyers. We don't need to share these responses, but we would certainly appreciate your feedback either now or on a go forward basis. And against that backdrop, I will say that reemphasize a point we made earlier. We are planning to create a conduit through which folks can contribute data to the tool. We do have fairly high, call it data standards, and so not all submissions will be accepted. But through the Market Monitor tool itself, look forward to a submission application in the not too distant future. Thanks, folks.
Thank you all for joining us today. It's been great to walk through the Market Monitor. If you have questions, comments, feedback, please feel free to reach out to us. I think we'll end the meeting here unless Dennis or Connie have any final items to add.
We did just get, Andy, I'm going to put you on the spot. We did just get one audience Q&A come in. We are working on the DC domestic content aspect, but really have to justify the cost to confirm and value add versus detract. If they change, is it still worth it?
I think I'll give that question to Connie.
Yeah. Well, given where you're sourcing your equipment, a number of manufacturers are already kind of getting ahead of, tackling the domestic content diligence front. I would say we're starting to see standardization in terms of what types of certificates may be provided from your manufacturers. And I think that's probably the easiest path to go down is if you are working with someone who's already met, domestic content on a number of sales, and are able to provide that certificate. I would recommend having your legal counsel take a look through to make sure it's comprehensive, it's not missing anything. And then also depending on how you're sourcing through your, I assume an EPC, if your EPC has familiarity with, steel or other iron or other, the domestic content that's not related to, for example, a solar panel, there's usually also a certificate process there. And so we're starting to see that kind of converge, and it's been pretty well received in terms of diligence, and it's helped to reduce transaction costs considerably.
Great. Well, thank you all for joining today, and look forward to staying in touch.
Thanks, everyone.
Thanks, everyone.